The new tax bill just introduced a new $6,000 tax deduction for seniors in addition to the standard deduction and the existing senior deduction. But what about the whole no tax on Social Security promise? Well, this bill does not fulfill this promise to seniors, but these new tax benefits may very well wipe out a large portion of your taxes if you fully understand the rules. Social Security income is already exempt up to a certain amount of income. Plus, your capital gains can be taxed at 0% up to a certain amount of income. And with all of these new tax deductions, you may very well be able to reduce your taxable income into ranges where you pay very little to no taxes at all. So in this video, I'm going to walk you through these new provisions and how you can position yourself to benefit from them as a licensed CPA that tax plans every day at mycpacoach.com. So let's go ahead and jump right in. Okay, so let's make sure you understand all of the exemptions and deductions you are entitled to as a senior as a result of this bill passing, and then we'll talk about some strategies here. So first, it is important to understand how your Social Security income will be taxed to put all of this into context. So at the time of this video, Social Security income is exempt from taxation when your combined income is less than $32,000 per year for married filers and less than $25,000 for single filers. Then up to 50% of your Social Security income is taxable if your income is between $32,000 and $44,000 if married, or if you are single, it will be between $25,000 and $34,000. And then finally, if your income is above these ranges, up to 85% of your benefits may be taxable to you as income when you go and file your tax returns. But even if that is the case, that does not mean that you will actually pay taxes on that amount of income, because you can still claim tax deductions to reduce your taxable income, which is where the new provisions in this tax bill become handy. So let's go ahead and walk through this, starting with the increased standard deduction, which has been permanently extended as a part of this bill. So in 2025, the standard deduction is $15,750 for single taxpayers and $31,500 for married filers. So even if a senior has $30,000 in taxable income, if they are married, they will be able to wipe out 100% of this income amount with their standard deduction, resulting in zero taxable income to pay tax on. That's how powerful these increased tax deductions are. But this is just the beginning. As a senior, the tax law also allows two additional deductions here. First, for taxpayers over the age of 65, you may claim an additional tax deduction up to $3,200 depending on your filing status. For example, single filers can claim a $2,000 additional deduction, and married filers filing with a spouse can claim $1,600 per spouse, giving them a total deduction of $3,200 if both spouses are over the age of 65. Then, with the most recent tax bill, seniors will be able to keep this deduction and take an additional $6,000 bonus deduction depending on their income starting in 2025. Which means when we add all of these deductions up, single filers will be able to claim up to nearly $24,000 in tax deductions here against their income, and married filers will be able to take nearly $47,000 in deductions against their income. And remember, these deductions are dollar for dollar reductions in your taxable income, which means a married couple with $47,000 in taxable income, even if it includes taxable Social Security income, they will be able to claim $47,000 in deductions here, leaving them, again, with zero taxable income to pay tax on. But what if you have taxable income above these deduction ranges? Well, the truth is that you can still save a large amount of money in taxes by carefully maneuvering your income through various tax brackets. For example, single filers with up to $48,000 in income and married filers with taxable incomes up to $97,000 would be able to pay 0% capital gains tax on their long-term gains, or up to just a 12% maximum individual tax rate on this portion of their earned income. So a married filer with $140,000 in taxable income would benefit from $47,000 in deductions bringing that income down to just $93,000. And if that remaining $93,000 in income were long-term capital gains, they would actually pay 0% tax on that entire amount, leaving them with no income to pay tax on. Or if the remaining $93,000 in income was from ordinary income, perhaps from taxable portions of Social Security, a W-2 job, business, or short-term capital gains, then it will be subject to ordinary income tax rates ranging from 10 to 12%. This is all possible due to the fact that this tax bill also extended the reductions in individual income taxes as well, which seniors will also benefit from. So while the no tax on Social Security promise was not fulfilled by this bill, seniors will be able to benefit from the increased standard deduction, the additional $2,000 to $3,000 senior deduction, plus the $6,000 bonus deduction per eligible senior starting in 2025. Which altogether will undeniably save seniors way more money in taxes. However, there are a few other things to consider, especially pertaining to the $6,000 bonus deduction for seniors, and that is the income limitations. This bonus deduction phases out for single filers earning above $75,000 in modified adjusted income and $150,000 in income for married filers. And if your income exceeds these thresholds, then your deduction will be reduced by 6% for every dollar of income reported above those levels. So seniors expecting any form of income really should carefully plan around these different limitations, deductions, and even tax brackets like we saw earlier to minimize their taxes. If you have any amount of money in unrealized capital gains or money sitting in IRA accounts, HSA accounts, and other buckets, then how and when you tap into that money will greatly impact how you will be taxed. And the order in which you pull from these sources is also very important, as each may have different tax consequences. For example, if you qualify for the 0% capital gains rate, you may decide that it's best to trigger some capital gains in that tax year instead of pulling from other sources. Or if you are in a very low tax bracket, you might decide to take some distributions from your IRA or do a Roth conversion. And on the other hand, if you are in a very high tax bracket, you might decide to pull from your Roth instead of triggering income from some of these other sources. Ultimately, these are all things that ideally your CPA is helping you plan around. And if they are not, and you just so happen to be in a high tax bracket right now, just apply to work with my team today at mycpacoach.com.